How much should you pay in quarterly tax estimates? It's always It's always good to get into the habit of making sure that you've paid in 110% of what your tax liability was in the prior year, and try to pay it throughout the year. This applies to both IRS and any states that you file in. That's a really good way to keep your penalties and interest at a minimum. But you should also get in the habit of evaluating your income during the year, because if you're going to make a significant amount of income more in the current year than you did in the previous year, you're going to want to pay in some additional quarterly estimates to reduce any potential for underpayment penalties. Now, underpayment penalties are assessed if you didn't pay enough of your tax owed during the year. And this is what most business owners are afraid of initially. The IRS will allow you to either pay 90% of your current tax liability during the year, or 110% of your prior year's liability during the year, to avoid significant interest and penalties. But since the current year tax liability is a moving target, which sometimes isn't even known until 6 months after the tax deadline, it's best to use the prior year tax liability as the gauge for the current year tax payments that need to be made, especially knowing that you will owe more at tax time, assuming you made more money. But I have good news. When people talk about filing quarterlies and doing their quarterly taxes, ignore them. There are no quarterly income taxes to file. I don't care if you're Susie Joe Donuts in Bridgeport or Amazon. Every individual, every company, every entity only files one tax return every year. And it's likely due either in March or April every year. The only requirements business owners have related to their business or personal income taxes quarterly is to pay quarterly tax estimated payments. And I use requirements very lightly because it's not enforced at all. The only thing you get if you don't pay in during the year is interest and penalties assessed on whatever the tax is that you owe when you finally pay it. The quarters are what are on Form 2210, which is used to calculate the interest and penalties. So it's easiest just to use those dates as your payment guides. It's important to note that while you don't have any quarterly income tax filing requirements, you might have quarterly, if not monthly, payroll tax and sales tax filing requirements. So keep an eye on those items as well. Quarterly tax payments at the IRS and most states are due April 15th, June 15th, September 15th, and January 15th. This doesn't exactly line up to be quarterly because that would make too much sense. So make sure you mark those dates down in your calendar right now, so that every year you're reminded to pay in estimates if you decide you need to, and you have the cash laying around to do so. The IRS suggests quarterly estimates, but we have a few clients that send the IRS a direct payment via irs.gov every month, based on the performance of the business in the previous month. So it's not an exact science, but we've come up with a formula that gets them pretty close to the tax balance owed, and of course we make adjustments during the year. But know that you can pay into the IRS any way you want. As long as they get their money, they don't care how they get it. The same goes for most states. Out of the clients that we work with, I'd say that 20% regularly pay each and every quarterly estimate. But most business owners are so cash strapped that they don't want to pay in the tax money early, even if it means some fines and penalties down the road, because if they need that cash for whatever reason, the IRS won't give it back to them. So the first thing I said was to pay in at least 110% of what you paid in taxes last year. Now the complicated part of this is that if you have a spouse or a W-2 job and a business, you have a few other things to factor in because money could be paid in from other sources. So look at the last tax return that you filed, and what does it show for your total tax? On the 2020 1040, it's line 24. So multiply that number by 110%, and that's the amount that you need to make sure you have paid in, whether it's via W-2 payroll withholding or via tax estimates. So if you paid a total of $10,000 last year in taxes, make sure you pay in at least $11,000 in the current year. And if your spouse is on pace to have $3,000 paid into the IRS via their payroll during the year, then you only have to come up with $8,000 in quarterly payments. So that's $2,000 per quarter, which will cover you for any potential tax penalties for not making payments during the year. Now, if you had an awesome year and it turns out that you owe $18,000 in taxes, you'll have to come up with the $7,000 difference when you file your tax return. But at least it won't be $15,000 because you've already paid in some money. That's why tax planning is so important. You want to pay in as little interest and penalties as possible, but you also want to plan for the actual tax bill that will be owed. And there is power in having that knowledge 9 months before it happens rather than waiting by your phone for your accountant to reach out with the final result. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.